Well, hi everyone, and welcome to this week's edition of Feeling Smarter. As always, I'm joined by my co-host Tim Miller. G'day, how are you?
Aaron, going very well, thank you.
Nice to see you in person.
Absolutely, always a pleasure.
Well, we have completed our SMSF pensions masterclass, and one of the, most topical areas was around the transfer balance cap considerations. And clearly, when the example we used, had our case study of our little brewers and Andrew, whereby we had a pension that was in existence, but we then are looking to commence a further pension, noting that the accumulation balance was greater than the actual transfer balance cap amount that he had remaining to him. So it did pose an interesting question about how you might look to structure up Andrew's affairs to his transfer balance cap. So do we, in essence, look at the balance and effectively only move the allowable amount up to his transfer balance cap limit, which in this instance wasn't 1.9, but it was a proportional component of that because of that commencement pension having commenced? Or do we look to exceed that cap and then make the necessary adjustment? And there are a number of factors that become quite interesting here that I thought would be a good part of our discussion today.
Yeah, and look, I think I take a fairly simplistic approach to it, and that is that planning within your own interest with reference to multiple pensions
Yep.
is not too dissimilar to planning for a spouse from a pension point of view. So
Yep.
whether a pension is a reversionary pension or a death benefit income stream, it requires a little bit of planning,
Yep.
and often that planning it coincides with an amount that's going to push you over the transfer balance cap, whatever your
Yep.
personal transfer balance cap is. And so I think that the way that the provisions have been written around the transfer balance cap make this, for me, almost a bit of a no-brainer. But I'm not suggesting it's always a no-brainer.
Yep.
But in this particular situation where we had a client who had a significant portion of tax-free proceeds in his accumulation interest.
Yep. So sale of business proceeds and downsizing contributions, NCCs. So
Yep.
we've ended up with $1 million out of 1.1 or whatever it was,
Yep.
is effectively in the tax-free component.
Yeah, that's right. That's right. And so to me, it makes sense given that the way that the transfer balance account works is that it's measured at the end of the day, which
Yep.
is a bit of a different concept. And so what it means is that so long as you're aware of what the transfer balance account is, and you know how much money you have in accumulation, then you will know what like your overs and unders,
Yep.
ultimately. And so therefore, to me, it's one of those situations where you go, well, we can commence a pension on one day for the full value of our accumulation amount, given the tax-free percentage of it.
Yep.
And then we can, on the same day, do a partial commutation of the existing pension and roll back a more appropriate tax-free taxable amount to the accumulation interest.
Yeah, so the existing pension, if we call it the account-based pension number one, had a 28% rough allocation of tax-free component in it.
Yep.
Now, the challenge then, and this is, I guess, where a lot of the discussion came from, is that if we took it up to the cap, then we're not utilising all of the tax-free money in that second pension, of which we're trying to do. We're trying to lock in that tax-free proportion based upon all the monies that reside within the accumulation account prior to it moving into the retirement phase. So then the question is, well, yeah, but should we be rolling back part of that amount? And it therefore becomes important about the timing of that, because as you said, you have an end of day approach when we look at that reporting, because it's daily, it's done from the transfer balance account provisions. It takes an end of day approach to deal with that. And we then further discuss the issues is, well, what happens maybe if wouldn't we just make the adjustment first? So what are the implications therefore of making that adjustment first?
Yeah, so I guess the primary and most unforgiving, but that's not quite the word I'm looking for. But the issue that you've got is if you make the adjustment first, then you are ultimately putting that money back into the accumulation
which
account.
can only ever have one interest.
Correct. And so therefore you're somewhat tarnishing,
Yep.
based on the difference in the tax-free and taxable of each, you're somewhat tarnishing the tax-free percentage. Now, it might not be significant in some instances. In this, we're talking about an amount that was 28% tax-free versus a new accumulation interest, which was 93% tax-free.
Yep.
So it can be significant. And so I think, therefore, the option of starting the pension first and then doing the commutation from the first pension is the more appropriate way if there is a consideration of the tax-free and taxable breakdown.
Yeah, so I think there's some really important lessons in there to be looking at the construct of the client. And this is obviously relevant where we have the balance that is ultimately going to move into retirement phase and be assessed against the TVC would create an amount in excess of what their available limit is. This is not going to be relevant for someone that might have a $300,000 pension in existence and they're going to add another pension in there that's going to be within the confines of the transfer balance cap of their instance.
Correct.
So therefore, there is some planning and understanding of some of those nuances in there. And not only are we looking at the timing of when those contributions may have been made originally, but we're also then contemplating how and when we might be starting those and to what extent we're going to be starting those pensions, because, as we said, getting it right in terms of adjustment first, and therefore in that instance we would be left with a much higher tax-free component sitting in accumulation because we've only taken ourselves a limit, or conversely, do we take ourselves past the cap, but then we need to simultaneously reduce back from other interests and create that debit so that we end up in the neutral position to the personal transfer balance cap at that time.
Yeah.
So there is plenty to think about there. And so that was, I guess, the one area, Tim, that probably stuck out to us from our SMSF Masterclass. To those of you that joined us, a very big thank you for being a part of it. And for those that didn't, here's your opportunity to make sure that you sign up to our future masterclasses and also be a part of our membership, which naturally includes these as part of that subscription. So thank you once again.
No worries, Aaron.
Good to see you face to face.
And you.
No doubt we'll be doing one again in the next couple of weeks.
Indeed.
Take care and bye for now.
Bye-bye.